right, good afternoon, everybody. Welcome to the February 4th, 2022 edition of News from the Front Lines of Business by D.W. Huff Consulting, where we help you know your numbers so that you can grow your numbers. All right, welcome, everybody. Looks like we made it through another week here, so we're going to talk about what's going on in the business world. First of all, fun with numbers. Not really a number per se, but two. So you may notice there's two different chairs there, and if you ever kind of look closely at my background, the chair that is on your right is my old chair. All the covering is worn away and done, and the one on the left is my new chair, courtesy of Quartermaster Grocery. He came by to work on some things, and then when I was at my desk, he noticed how bad my chair was, which I have never noticed because I just sit in it and don't even care. But anyway, got a new chair, very comfortable, very appreciative of that, and yeah, so now I can be hopefully a lot more productive with a good chair. So anyway, that's it for today. And it's cold, and I guess I could have used the temperature and everything. But anyway, so it's gonna be another short one again without a lot of graphics. A decent amount of things going on here, and I just want to share with you observations and things that have happened during the course of the week here, and discussions with clients and things that are useful to you. But first of all, I had a couple discussions about the Metaverse, and yes, basically it's a game. So for those of you who don't know, like I'm still getting up to speed on it myself, but it's like a game, so virtual reality. So you'll see the pictures online of people with the helmets on to kind of block out the outside vision, so you can see just what's being projected to you. And you kind of walk around, play games, go to people's houses for parties, that kind of thing. So it's a whole other alternate universe. And what's going on now is people have finding ways to sell real estate on the Metaverse and buy and sell it with cryptocurrency. So we've got all this stuff that's virtual, not real, but people are making money on it. So I'm just, the more I've been doing this accounting business, the more I realize I'm just amazed by how people find ways to make money with stuff, and this is just yet another example of that. So, I guess you could be kind of, if you're scared and very risk averse, the fact that you would have to pay for some virtual real estate or some other virtual thing with a non-fungible token or whatever it is that you can then sell to somebody else, but people are making money with this right now. So they're selling this stuff that doesn't exist to people with money that doesn't exist, and in some cases converting it to real money. So, I guess there's always a way to make money on things, and if you're entrepreneurial, and that's what's happening in the Metaverse. So, I guess as always, be careful if you do decide to jump into that, because I guess you got to realize it is a game, which is why I'm kind of, concerned about how. Just how it's going to play out, because it's a thing, and if people stop playing the games, it'll all just dry up and go away. I don't know, so be careful. Also had a few discussions about the meals deduction. So, currently, if you, for business purposes, going out to eat at a restaurant, it is now 100%, and it used to be 50%. So, but I guess we got to be careful because there are a couple changes to it. Used to be you could have pizza delivered to your office, and that would count as a meal. Now you pretty much got to go out somewhere else to another restaurant. So buying stuff to consume on your premises kind of negates the deduction, whereas going out to eat gets you the deduction. So slight change in rules, but that has come up as we're doing kind of we finished up some year-end planning, and we're classifying a few things, and we're seeing this meal expense on there. We just want to make sure we're aware of the fact that the rules are a little bit different this year. And as always, you could reach out to us. Office and home has come up quite a bit. So there's pandemic-related things. A lot of people were having to work from home. If you own a business, it's going to create more opportunity for deductions for things that you're already expensing in your house. Your repairs to your home, your utilities, things that you're paying for anyway that may not ordinarily get you a tax break. Now can. So if you had to work at home, for the pandemic, or whatever, and even though you might have another office somewhere else, you're allowed to take this, this percentage. You don't get all of the expenses. Obviously, it's limited to how much business you should have, but that's come up quite a bit because we have a lot more people doing work from home, and we want to make sure that they're getting every deduction possible. So be sure to ask about that and track those expenses, because it's you know, it's money you already spent, so it's not like you got to go out and spend anymore, and you can save a few tax dollars. Also, big in the discussion boards is this child tax credit. So for those that don't know, it used to be that if every child you had under 17 years old, you would get a $2,000 tax credit, which is basically like another payment that you made to the IRS. So if that increased your refund or decreased the amount of tax you had to pay, that was like another payment that was out there. This last act, the Rescue Act, increased that to $3,600 a year for kids that are under 6, and $3,000 for kids that are over 6. So in either scenario, it increased it. But what's kind of complicating things is that last year they started giving out. So basically, they took whatever the credit was. So depending on the age of the kid, is either the $3,000 or the $3,600, and they basically split it in half and sent out monthly payments for the last half of 2021. So some people have already received some of this money, and it's causing some issues because people who were accustomed to receiving a $2,000 credit when they prepared their tax return no longer have that because they've gotten some of this money already in the form of a check, throughout the course of 2021. So now when they come around to file it, in the case of, let's say we had a kid that was over 6 years old and you got $3,000, right? So over the course of last year, you would have received those advance payments that would have totaled $1,500. So when you file this year's tax return, the remainder of between the $3,000 that you were allotted and the $1,500 you've already received through advance payments, now you only have a $1,500 payment being applied against your taxes. So some people are seeing unusual amounts of refund, and I guess they're not totally aware of the fact that they've already received $1,500. So that money's long spent, I'm sure. And so the issue is that now they're getting the tax returns filed and they're either owing a little bit or getting less of a refund. Or in the case of the $3,600 deal, it's slightly different. But in either case, you got the money up front, and now you're seeing a tax effect when you file a tax return because the credit that what's left over is not as high as the $2,000 that used to be in play. So I did see a guy on Facebook. He another CPA locally here. He posted a little example like that, and that's the gist. What I told you is just the gist of what his example is. But that's basically you already got the money up front. So some people are kind of upset now because the refunds are lower, and that's the cause of it because you already got that money, and a lot of times it's easy to kind of lose track of that. We also had another discussion about the value of a Roth IRA. A client came in here and we were talking through the tax stuff and kind of expressed to me her regrets of if she would have known some of these things early in life, how she would have took better advantage of them, because now she's pulling out of a regular traditional 401k type account, so there's some tax implications there when you increase it. But a Roth IRA would have been preferable in her case because of not wanting to have to deal with the taxes at this point in her life. So just a reminder, Roth IRA is completely tax-free when you take out a qualified distribution in retirement. And we also talked about this vacation home strategy. So this is something that's come up not in the regular mutual fund Roth IRA, but inside the accounts that we do, that you handle as a self-directed Roth IRA. I've seen this example worked out a few times where all you got to have in the Roth IRA is enough for the down payment on, say, a vacation home. And this is a deal where, if you start it young enough and you get, it's not unusual to see these things out in Florida and some of the things on the Gulf Coast that are, not very high dollar vacation properties, still nice, still fun to go to. But where, if you can accumulate $20,000 or so inside the Roth IRA and then move it over to a self-directed IRA, that's your down payment. They do have these banks that will do the type of financing that's required to keep this Roth IRA in place. So you can buy a rental property with $20,000 or so down, maybe a little more. In this theoretical example, finance it, rent it out, and that income comes in tax-free. Right? The loan payments are paid with the tenants. Hopefully we rent it enough so we're covering our mortgage payments. And at the end of the term, you have a paid-off property that you can now just take completely out of Roth IRA and use it personally, because that is a restriction with this self-direct stuff. We can't use it. So in the time that it's inside this self-directed IRA, it's not available to us. It can only be rented out. But if it's something that we want at some point in the future, this is the way to have it paid off by other people, using other people's rental income to pay down the mortgage, and at some point take it out and distribute it to yourself tax-free. So that is a good idea, and it's definitely a doable thing. I mean, a lot of these some of these vacation zones, definitely in our area in the Gulf Coast, and I suspect other areas, we don't have to come up with $1 million for a condo somewhere. I think a lot of these beachfront deals are inexpensive enough where a reasonable balance in a Roth IRA can get you the required down payment, get you in. So mention that to you. Also, this article here in the Tax Advisor, I posted the link. But a lot of people getting notices, and the issue now with which I'm sure you've seen lots of this before. The phones, you can't get through the IRS. So you get a notice, and let's say it's wrong, and you have to try and talk to somebody to fix it. You're on hold for a long period of time. It's really been difficult to get through. If you mail a written response, it takes them a long time to process that mail and get back to you. So a lot of times you get a notice, you get a follow-up notice, you get a threat of levy and seizure and everything else, because these computers generate these notices at regular intervals no matter what's going on in the background. Well, they basically, the AICPA and some other tax professional organizations have reached out and have agreed to stop some of these automatic penalty notices from going out until they can catch up on some of the backlog and work and I guess deal with the issues that are resolved. So that's something that I've been pushing for, I've been hoping for a long time now, that it's okay if you slow to deal with stuff, it's fine. Stop causing the problem with these penalty notices that we have to deal with. So, and that's I think the common sense has kind of come to the top here, and that's seems to be what's going on. So we should see less computer notices to deal with. So anyway, so that's about it for this week. My closing thought for today. So my Stoic philosopher Seneca there. So this came through on my daily thought here, and I'll just leave it up there for you. But basically, Seneca was one of the early philosophers, and he had this lung issue suspected to be tuberculosis that almost killed him way back when, and he managed to live, but he never had a really great state of health going forward. But going through that experience and that near-death experience really, I guess, made him appreciate life a lot more. And there's been other examples of that with some other artists who weren't really accomplishing much of anything, but in some cases they've had these near-death experiences, and then all of a sudden everything became more important, and they did their best work, post near-death experience. And there's some examples of that in Montaigne and George Lucas, Stephen King, some ones that we probably know of. So I found it interesting. Sometimes it takes a near-death experience to really make you appreciate life. So that's what I took away from it. So the closing thought on that is read the obituary. So I just had a couple people this past week that I noticed that had passed away, and it's kind of makes you realize how, I guess, mortal we all are, and that we're getting older. But that's the thought here. Read the obituary. So if I guess you ever feeling complacent or unhappy or ungrateful or whatever, read the obituaries, because the people just like you and me who are no longer with us, and they have no different life struggles than we do, and they deal with it, and be glad it's just still here, I guess, is the takeaway. So with that, I'll leave y'all for the week. Have a great week, and we'll be back at it Monday. Take it easy.